How are you doing, young students? This is Sergio Quero, and today I'm going to be talking about banking and how they create money supply.
Buddha bless this beat.
So how does a bank create money supply? Well, there are a few things that must be taken into consideration, one being excess reserve, the other being reserve requirements. Reserve requirements are set up by the Federal Reserve, which determines the minimum reserve ratio that a bank must hold, which is 10% in the U.S. Excess reserves are any additional reserves that's held beyond what is required. So you may still be wondering, well, how does this increase money supply or create money supply? Well, here's where stuff gets interesting.
So here I am standing in front of Wells Fargo. If I were to deposit $1,000 into this bank, a reserve requirement of 10% must be taken into account. So $1,000, 10% of $1,000, which is $100, must be kept in this bank at all times. The remaining $900 from that 1,000 is considered excess reserves. With excess reserves, they can loan out to other people or other banks, which is how they create money supply. So now that those $900 in excess reserves have been loaned out from Wells Fargo, let's say those $900 now got deposited into this new bank. Those $900 would then be ran through the 10% from the reserve requirement. Now there would be $810 in excess reserves and $90 in reserve requirement in this new bank. So now that those $810 have been loaned out from the previous bank, let's say they got deposited into a new bank. Now there's $729 in excess reserve from this bank and $81 in reserve requirement staying in this bank. So with those $729, they can now loan out to new people, new banks, and this will continuously increase money supply until there's no new money to be lent out.
Did you get all that? Well, here, let me walk you through another example.
So let's take a look at this diagram. There's an initial $100 being deposited into that first bank. 10% of those $100 must be taken into account due to the reserve requirement. $10 will now stay at this bank, and there's now $90 in excess reserves, which will get loaned out and eventually end up into another bank. From that second bank, 10% of those $90 must be taken into account again, and now there's $9 left in this bank and $81 in excess reserves, which will be loaned out. This will eventually happen again and again. So you may be wondering, well, is there an easier way to determine how much new money will be added to the money supply? Well, granted, there is a formula called Money Multiplier, which is equal to 1 over the reserve ratio. So here, let me add on to this example. So, looking back on the diagram that I just showed you guys a few seconds ago, that initial $100 that was deposited into the first bank has already been counted towards money supply, so we don't use that in our equation. So we take the 10% of the reserve ratio, put it into decimal form, and solve for 1 over the reserve ratio, which is equal to 10. So those $90 in excess reserves is the first new money that was added to the money supply. So to determine how much new money will be added towards money supply from that initial deposit, we take 1 over 0.10, which is equal to 10, and multiply that by the first amount of excess reserve, which will now give you $900, which is the new amount added towards money supply.
Thank you guys for watching. Hope you enjoyed the video.